Welcome back, guys. We're going to start out this discussion, Economic Background Part 2, by looking at some of the employment numbers. And the first number that we always hear of is the unemployment rate. And we can see that in April, and that is the most current information available. It comes out on the first Friday of the month. And as you can see, in April, we had an unemployment rate of 4.4. And you look where it is, if we go back here, this is the height of the Great Depression, Great Recession. And you could see that we're almost at 10%. So basically, since 2009, that been winter of 2009, when President Obama took over, to where we are today, we've seen the unemployment rate decrease significantly. In fact, if you actually look at it in total numbers, you can see that the civilian labor force has expanded exponentially over the past 30 years. But more importantly, we see how it's really increased here. From 2009, we've seen that it has increased substantially. So that if you look at it from right about here, we have added over 5 million jobs. That's a lot. But the one thing that we've really got to pay attention to is the labor force participation rate. And we've seen that drop. So these are the people who are in the workforce or looking for work. And what you can see is 63% of the population at the end of April is in the labor force. So 4.4% is of that 63%. Now, what that includes is students are not in the workforce. Children are not in the workforce. Retirees, students, those that are disabled are not in there. But still, we've seen a significant decline in the number of people participating in the workforce. And this is a long-term, it's going to go with the aging. It's clearly going to go with the aging. But there's a lot of people who are not in the workforce for one reason or another. But those that want to be in the workforce are in the workforce. In fact, when we look at it right now, when we look at it, and this should be a positive thing, when we look at it by educational achievement, we can see that those with the bachelor's degree or higher, have very low, less than 2%. And the unemployment is those without a high school degree or just with a high school degree. Now, one of the things that's missing on this that we don't see is the jobs that go unfilled. Right now in the U.S., there's almost 5 million jobs that go unfilled because of a lack of skills. And that's a huge number of people, jobs that are open. And if you have the skills, you can get these jobs. And they range from fairly, you need a high level of education, but the openings for those in many, many fields is huge. A simple one is repairing drones. As more and more companies are using drones, there's no one to repair them. The skills to fix drones is minimal. So they range from the trades to technical people, those engaged in data analytics. You can't find enough people who know data analytics. So there's so many openings. And I think when you look at that, that's where we got to look at this from a societal perspective and say, why is it that we can't fill 5 million jobs? Well, one of the big things is when we come back and look at where the unemployment in the country actually is. And it's in those without a high school diploma or with a high school diploma. Those are the ones that still haven't moved forward. Those with higher degrees have almost 2% is almost nothing. So the economy as a whole is reaching full employment. When we look at who's working, who wants to work, we're at that point of full employment. Now that has the risk, remember now, if you want to grow, come back to the supply and demand. Okay? If there is demand for product, okay, that's the consumer wanting something primarily because the majority of what we do is consumer-based in our GDP with some investment, some government spending, and to produce more, you're going to need more people. But if there's a shortage of people, we don't have enough people, how are those jobs going to fill? You can't have growth. You can't have growth without having more people working. But the people that want to work, we don't have the skilled people. So that leads us to what's going on. Now, I think there's a lot of forecasts going on out there, but this is what I'm looking at right now, is we're struggling in the U.S. to make 1.5% to 2.5% growth. I think we're going to keep looking at $50 a barrel oil, which keeps some oil in the ground, because it doesn't make sense to lift it out unless it's worth more. I see 2 Fed rate hikes. I think some of it, we're going to see some defaults on high-yield bonds. I think the consumers, as I said before, are going to remain very, very positive. But spending, not so much. They feel good, but spending is not growing, especially in the physical space of retailers. Business spending is slowing because if they're not sure there's the demand, we keep hearing the consumer is good, but we're not seeing it. The strong U.S. dollar continues. Inflation starts becoming an issue, especially as the economy moves towards full employment. I think we see China slowing down to 6%. Europe is coming back. Surprisingly, where we were at the beginning of the year and where we are now, we're actually seeing Europe growing at 1.5% to 2%. Japan is actually showing signs of life, and global growth is still hanging between 2.5% and 3%. So that's just sort of that's the environment in which businesses operate. They're making decisions based on that information. They're making decisions on investment in equipment and for further research and development, preparing for the future. They use that. They're making their sales plans. They're trying to determine a lot of different things from that. So this becomes important. The last section that we're going to take a look at is the policy impact. And there's certain policies in the U.S. and the world that we have going on that will impact the economy. Okay, so we looked at what these big overarching themes are: globalization, aging of the planet, and growth within the emerging markets. And we then take a look at what is the policy of our government that will start to impact things. And I've called some of them the T factor. What are we going to do with trade? Are we going to come out isolationist, or are we going to continue to engage in the world? As you can see, that when we look at our exports and imports, we can see they're almost balanced. So you got to be very cautious there. The tax, we'll talk about that. Healthcare, regulation pullback, which gives us more incentive to invest. But there's unknowns there because we don't know where it's going. Employment, as I said, we're at full employment. Inflation and interest rates, the Chinese economy, and commodities, especially oil, will come in. And when you look at trade, and an exchange is simply the value of one currency compared to another. It's either a market or it's pegged to something else, that it moves in relationship to, say, the US dollar. From a US perspective, the higher value of the dollar means imports are cheaper for Americans and exports for America are more expensive in other countries. Okay, so that means if we buy something from Mexico, from China, from Brazil, from England, wherever, that is going to be cheaper for us as Americans to buy. Thus, we will want to buy more, making that number more negative, okay, reducing our GDP. On the other hand, remember, we still export 2.3 of goods, $1 trillion of goods. So you take that and say, okay, other countries aren't going to buy it because it's becoming too expensive for them, so they can get it elsewhere. The dollar is strong and predicted to remain strong, so the risk is that with the high dollar, imported goods become even cheaper than they have been, thus making that trade imbalance even greater. Trade agreements can define what can be traded, what tax or tariffs are added. And this, what's going to happen with this, we don't know. We simply don't know. One moment we're going to rip up NAFTA, next minute we're not. So I think we got to wait that going forward. The major risk that we have here is that each country taxes everything else. So if you're looking at what we import, and say we import a lot of fruits and vegetables from Mexico, and you put a tax on that, Who buys fruits and vegetables? American people. So they're going to have to pay more. So it's really a fine line between that. And when we take a look at some details here, I didn't update this. This is that year, but it's close enough. You can see that we export about 564. What we export are capital goods, services. But what are we importing? Consumer goods. Okay, a lot of food, parts, foods, feeds, and beverages, services. I mean, there's a lot that balances out here. So really, this is all exports of goods. These are jobs that are created in the U.S. This is what we bring in from elsewhere. A stronger dollar makes these more affordable, makes these more expensive to the buyers. And if we summarize that real quickly, you can see that the gaps, where it is, food, consumer goods. A lot of this, we export capital goods. What we export tends to be higher value than what we import. So we got that risk, that trade risk is out there, and we saw the global supply chain, it's all connected, but that's policy, okay? Then we look at the proposed tax cuts. And I think everybody would agree that we need tax reform and that a tax rate would be beneficial to the economy. But what they're looking at is dropping the rate from 35 to 15%, eliminating the alternative minimum tax, and letting companies bring back profits that are overseas and tax them at a 10% rate as opposed to 35. So there's an incentive for people to bring money back from overseas and make investments and create jobs here. They give a credit for some investments. Personal tax, they're going to collapse 7 brackets into 3, 10, 20, and 25. Increase in standard deduction, limiting some itemized deductions. No alternative minimum tax there. And they'll add some child care credits. When you look about who's benefiting from these tax cuts, you can see who's really getting the most. And when you look at it, it's the top 20% who are getting 82% of the tax cuts. And that's your 80-20 rule or Pareto principle. So we see that. And then when they break the wealthiest 20% down, take that, we look at the next page, what you can truly see is those in the top 1% are going to get all of the benefits. In fact, the top 5-6% get all of the benefits. So let's take another, so that's the tax symptom. But let's look at this for a second and say, okay, let's simplify this. Tax savings and in money is instead invested and generate more jobs and tax revenues. So the theory is that if you give people tax cuts, they will invest, and that will create more jobs. But it needs to be tied to the demand for products. And if you are going to make an investment, you're going to need people, and we don't have enough skilled people, as evidenced by 5 million jobs today going unfilled because of a lack of skills. So we go back to that basic equation. Tax revenues less expenditures today equals a deficit. Okay? Very simple. The tax revenues do not cover the expenses, and that excludes Social Security and Medicaid. They're separate from this. Is the deficit. The proposal is if tax revenues go down and expenditures stay flat, the deficit will increase. Now, tax savings create more investments, create more jobs and tax. So the belief is there'd be no effect on the deficit. Now, spend more on infrastructure offset by less government spending on regulation. If it remains neutral, we still have the deficit. So I think we really look at a situation where unless you're either going to increase the deficit or you're going to have to raise revenue to cover expenses or reduce costs for the lower one. But that's not good from the long-term health of the country. So we got the tax situation. We got the Health Care Affordable Care Act. And I think I want to go back to some of the basics of what happened with the original Affordable Care Act that people are wanting to appeal. And the first thing is it moved from prevention, it moved from a crisis situation to more of a prevention and lower case-based model. So instead of going to the emergency room for care, you go to a doctor and you have your issues addressed before it becomes that serious. And it costs less, and you have better outcomes. Because a hospital has to treat you irrespective of your ability to pay. Okay, so you can go to the emergency room and it'll cost $3,000 for somebody to tell you have strep, versus go to an urgent care or a primary care physician or a physician's assistant. They tell you have strep and the whole thing is dealt with for $100. So it's much more expensive. So what the Health Care Act did was encourage more people to take preventive care. They standardized the coverage definitions. What's covered? A standard policy covered this, this, and this. And then included mental health, pregnancy, and chemical dependency. You are covered as an adult to your age 26. Otherwise, when you turned 18, you would have had to find your own health insurance. You can't be denied coverage because of pre-existing conditions. Mandate that you must have coverage, and if you don't, there's a tax penalty. So that's the fundamentals of the Affordable Care Act. And when we look at this chart, we can see that where do people get their health care? Okay? And you see that it's employers, Medicare, Medicaid, and here's the Medicaid expansion and subsidized plans, 7.2. That's still a lot of people. Private insurance plans, and then there's still folks that are uninsured. 10% of the population, though, is 30 million people. Okay, so you cut these two pieces out, that's 30 million people. Now, I want to go back to the basics here. And this one is a chart of healthcare spending. What it does, it takes all developed countries, and as you can see here, the largest one is the U.S. We spend more on healthcare per capita than any other developed country. Okay? And when we look at it, it's half the cost of the UK, Japan, France, Australia, Canada. So we spend more. Now, I would suggest to you that if we spend more, should the results be better than everybody else? Well, let's take a look at these outcomes. Look at the life expectancy. Who's the lowest? Infant mortality, 6.1. We're on the verge of emerging markets on infant mortality. Percentage of the population with 2 or more chronic conditions, 68%. Obesity rate based on BMI, 35% of the U.S. population is obese. Look at that, compare that to Canada, 25. Compare that to the UK, 24. Compare it to the Netherlands, to Japan. We're not in the same league. That's what's causing these problems. The only thing we come in good at is a fairly percentage of population who smokes. We're pretty low on that. But when you look at it, we're paying more and we're getting less on an outcome basis. And that's the fundamental question. Now, we've always heard it, many people have said, well, in Canada or in the United Kingdom, you've got to wait forever. Well, let's take a look. Okay? The practicing physicians per 1,000, we're down on the bottom. But this one here is really the one that fascinates me. In Germany, Japan, Australia, the average person sees a physician 7.7 times a year, half in the U.S. So you actually have better, you spend less, you have better outcomes, and you see your physician more. What's wrong? And that's something that I think we're the only developed country in the world who doesn't have single payer. And that's a question that we're going to have to, from a policy perspective, address over time. Now, here's another one, and this is even more scary to me. A lot of this is the opioid problem, but but in the deaths per 100,000 people ages 45 to 50, all these countries and Hispanic Americans have dropped since 1990 significantly. What about white Americans? Since 1990, they're up 3.4%. Okay? But there's a lot of other health issues. So we're spending a lot of money. We provide under the Affordable Care Act that if you do have insurance, it has to provide for chemical dependency treatment and mental health treatment. But we're clearly seeing that deaths in this are going up in the U.S. where everywhere else around the world we're going down. This is a policy issue. Okay. Next one is oil supply and demand. What happened is pretty easy. Here's the supply. The supply grew faster than the demand, and that continues today. We have more supply of oil, and that's keeping the price down. The people who are hurt by this the most are obviously Saudi Arabia, the Middle East, but Canada, Venezuela, Nigeria, Russia, and those that benefit are the U.S., Europe, Australia, and China. So those are the players that are involved in this. So people will benefit, but we're also finding that technology, we're not using as much oil, okay? And we're moving more, despite everybody's attempts, to more electric power, natural gas, and wind and solar. Okay, so we got that. The other thing we got going on is interest rates, and right now we're in very historically low interest rates. Short term is our overnight, up to 2 years. Medium term is 3 to 10 years maturity, and long term is over 10. So we got these low interest rates around the world, and it comes back to the supply and the demand for money. The more money is in demand, the higher the rate. The lower the demand, the lower the price. Corporations and businesses are not borrowing. They don't need the money because they're not making the investment. There's also a relationship between risk and return. The longer the term, the higher the rate. The shorter the term, the lower the rate. The greater the credit risk, the higher the rate. The better the credit scores, it's lower. So we don't have enough quality borrowers, and many companies do not need to borrow. So that's keeping demand fairly low. In fact, we just heard when we saw the quarterly earnings out of the banks, we've seen almost every bank's loans decline. They're not growing, which means there's not an investment going on. We look at U.S. government securities. They don't have any principal risk, but they have inflation risk. Okay? You may get your money back, but if inflation runs greater than the interest rates, you could lose. Next thing I want to talk briefly about is the difference between fiscal policy and monetary policy. Fiscal policy, how revenue is raised and how money is spent, is fiscal policy. That's approved and authorized by Congress. It's implemented, collected, and or spent by the executive branch. Okay, so now what they did is last week, 2 weeks ago, they did not complete a full budget for the fiscal year. They simply extended it, came up with an interim budget, did a continuing resolution, which funded the government through September. Come September, there's got to be a budget in place or another continuing resolution. That has some implications from a debt ceiling, but that we'll talk about as we move further. Monetary policy is controlled in the U.S. by the Federal Reserve. It's our central bank. It's independent. The president nominates and the Senate approves appointment for a set term. They can't be removed. And what they do is control the money supply by buying and selling securities. They influence short-term rates, and they're a regulator with influence and views. But a lot of it is by buying and selling securities in short-term rates. Now, the Fed has a couple of key policies that are set by Congress. Maximum employment, stable prices, moderate long-term interest rates. The first two are what's referred to as the dual mandate. Now, we've been in an environment where we're almost at full employment today. Okay, when you look at the numbers, the number of people, we're at full employment. Stable prices. Our prices have been very stable. We're not even growing at 2%. So that's stable, moderate long-term rates. So the Fed is actually doing what they said they'd be doing. But they're moving, on the other hand, all the central banks in the world have been moving in the same direction. Okay? U.S. rates are trying to return to a more normal or historical rate based on the growth of the economy. When we look at the ECB, Japan, and China, they're lowering interest rates to stimulate growth. So what will happen is, if the U.S. is offering higher interest rates, people will take money from these countries, put it into the U.S., and as they put it in, that creates more supply in the U.S. banking system, and there's no demand. So that'll keep rates pushing down as much as the Fed wants to, increasing it. Putting it all together, cautious growth. Okay? But expect volatility and headwinds as we move forward in the next couple of years. Let's ask ourselves the next question. How do these things impact you as a student May and June 2017 at SUNY Geneseo? 1, jobs. Jobs, jobs, jobs. It's going to predict what jobs are going to be in demand over the next 10 to 20 years. So hopefully you can prepare for those jobs that are not being filled. Focus your skills on skill development. What is that you need to take some of these jobs? And it's not just completing those academic requirements that are established for you. It's more. It comes back to your ability to support oneself and their family. It comes back to your quality of life, the ability to create wealth, planning for the future. So these things that I just spent time talking about impact you personally. Why is it important to finance? It's a framework for evaluating strategy of the company, a framework for evaluating the market for the company's products or services, a framework for making assumptions about the future when we plan. It impacts the customers, suppliers, and employees and drives their behavior. It impacts actions they take. So I want you to keep this economic background in view as we move through the rest of the course. If you have any questions, please let me know.